In the past 24 hours, $130 billion evaporated from the crypto market. Not withdrawn, not rotated, not transferred anywhere else. It didn't move. It ceased to exist. This wasn't panic. This wasn't fear. This was a pricing surgery. The system didn't collapse. It recalibrated. It removed value that had only existed as assumption, priced in by belief, but never backed by real flow. And the wall at 69,000? That is not where lives are saved. That is where the system signs off on what survives and what gets erased. This is market signals. To understand why 69,000 is terrifying, you have to understand what just died above it. 74,600. That level wasn't random. For months, it absorbed everything. Tariff panic, geopolitical stress, macro noise. It held, not because of hope, because structure was still alive. Liquidity defended it. Options stabilized it. Flows respected it. Then it broke, not on bad news, not on a black swan, not on headlines. It broke quietly. No volume surge, no fear spike. When a fortress collapses without an external attack, it means the inside is already hollow. The moment 74.6 failed in silence, the market lost its right to optimism. From that point forward, every bid became suspect. Above 74.6, the system was still defensive. Below it, the system switched modes, not emotionally, mathematically. Liquidity stopped absorbing risk and started processing it. That's when attention snapped to the next number. 69,000, the number everyone remembers, the top of the last cycle, the place people call strong support. But memory is not liquidity, and the market does not pay nostalgia premiums. If you're staring at 69,000 and thinking, this is strong support, someone will step in here. Stop. Support only exists when someone is willing to buy with real money. Not belief, not expectation, not hope, not fake orders. We didn't look at charts. We looked at the ledger. On Coinbase Prime, roughly 2,450, Bitcoin appeared as bid interest between 69.5 and 69.8. On the surface, it looked like protection. In reality, those orders were pulled the moment price approached. That's not defense. That's spoofing, stage props, placed to slow you down, placed to keep you watching, placed so you hesitate while exits are sealed. A real wall doesn't disappear when pressure arrives. This one does. At the same time, BlackRock moved nearly 4,000 Bitcoin onto Coinbase Prime, not to buy, to settle redemptions. When investors exit ETFs, the fund doesn't argue. It liquidates. No conviction, no diamond hands, just mechanics. Bitcoin isn't being hated. It's being used as the last liquid asset to pay cash obligations in a system running out of alternatives. This is what forced selling looks like when it wears a suit. Now comes the part no one wants to hear. Above 70,000, just above this 69 level, options dealers are required to buy dips to stabilize price. Below 70,000, they must sell into weakness, not because they want to, because the math commands it. This is the betrayal of mathematics. Every leveraged long placed at 69 forces the system to sell more Bitcoin to hedge exposure. The more people defend the level, the heavier the automatic selling becomes. The algorithm has no emotion. It only executes the sentence your hope signed. At the same time, the futures basis collapsed. CME futures flipped into backwardation, spot trading above futures. That signals stress, not confidence. Institutions aren't paying up for future exposure. They want liquidity now. When futures stop commanding a premium, long-term conviction is gone. What remains is damage control. Meanwhile, Bitcoin mining hash price fell to near $35 per petahash. That's operational pain. At those levels, miners don't strategize. They sell. Not because they're bearish, because electricity invoices don't accept ideology. Supply doesn't increase when price falls, but forced supply does, and it arrives exactly when bids are weakest. This is not isolated to Bitcoin. Ethereum is showing the same stress signature. Bitmine, one of the largest ETH treasury holders, is now sitting on over $7 billion in unrealized losses as ETH slips below 2,100. This isn't collapse, it's pressure. And pressure doesn't break markets immediately. It forces behavior. Even protocol insiders are moving. Over the past 3 days, Ethereum's founder has been converting exposure into liquidity, not to crash the market, not to signal fear, but because in stressed systems, liquidity outranks ideology. This is how contagion actually spreads, not through panic, but through quiet balance sheet decisions made long before headlines catch up. 69,000 isn't support, it's an execution point. It sits at the intersection of the 2021 cycle high, the 2024 range low, negative gamma territory, thin volume profile. Below it, there is an air pocket, a liquidity vacuum. Real bids don't cluster at 65. They don't cluster at 63. They cluster near 59, lose 69.6, and price doesn't walk down. It falls, not because of fear, because there's nothing underneath to catch it. And at the end of this corridor, waiting patiently, is Binance's SAFU fund. Don't mistake it for a rescue team. It's a vulture fund. SAFU doesn't buy stability, it buys aftermath. It doesn't place bids during calm. It deploys capital when liquidation engines are exhausted. They're not here to save you. They're here to acquire what's left after accounts are zeroed and leverage is erased. They don't catch falling knives. They acquire the wreckage. Below 69,600, there is no structure, only speed, only slippage, only the realization that markets aren't designed to protect participants. They're designed to filter them. This isn't a forecast. This is documentation, a record of what happens when belief collides with mechanism. If you're asking where the bottom is, you missed the event. This wasn't about price discovery. It was about eligibility. Who gets to remain after the system recalculates risk? 74.6 was the warning. 69 is the procedure. What comes after is simply cleanup. This is not fear. This is structure, enforcing selection. This is market signals.